So, you've got a winning strategy. Let's be real, that's the hardest part, right? You've already done most of the heavy lifting. But to get funded, and more importantly, stay funded, you've got to master the vehicle you're driving, the prop firm platform. See, it's not just about being right on the direction of the market. It's about executing your plan flawlessly.
All right, let's get right into it. Today, we're going to cover 4, let's call them mission-critical areas that are going to bridge that gap between having a great strategy and actually getting that funded account. We'll start with a huge misconception. Then we'll get into the tools of the trade, how to size your positions, and finally, the blueprint that puts it all together.
Okay, first things first. We absolutely have to talk about the single biggest, and I mean biggest, misconception in prop firm trading. Seriously. Getting this one thing wrong is the #1 reason why most traders fail. They blow up before their strategy even gets a fair shot.
And this right here, this quote from trader Nick Updike, this is the golden rule. You need to burn this into your brain. It says, your available trailing drawdown is your account size. That big, flashy number they advertise, the 50K account, that is not your real capital. This is a total mindset shift you have to make starting right now.
So what does that actually mean? It means you're not trading a $50,000 account. You're trading, in reality, a $2,500 account. Let that sink in for a second. Every single decision you make, every entry, every exit, has to be laser-focused on one thing: protecting this small, unforgiving buffer. That right there, that's your real lifeline.
And look, you gotta understand the game you're in. As another trader, Sean Farrow, points out, the whole system is kind of built on the expectation that you're gonna get emotional, that you'll see that big fake account number, over-leverage yourself, and just blow up. So our job? It's to be disciplined. It's to beat them at their own game by playing smarter.
All right, so if we're gonna protect that precious drawdown, what do we need? We need control. Absolute, precise control over every single trade. And that precision? It all starts with understanding the 3 fundamental order types. Think of these as the tools in your trading control panel.
First up, you've got the market order. This is your get me in or get me out right now button. You hit this and you're in at the best available price, period. Speed is the priority here, not the price. It's perfect for those moments when your setup is happening right this second. Or, just as importantly, when you need to bail on a bad trade like yesterday.
Okay, next, we have the limit order. Now this is the tool of a patient trader. This is you telling the market, hey, I'm only interested if you give me my price. You use it when you've picked your spot and you want to buy at a discount below the current price or sell at a premium above it. No compromises.
And last, but definitely not least, the stop order. Now this one's kind of interesting because it gets triggered when the price moves through your level. It's the opposite of a limit order. This makes it the perfect tool for 2 things: entering a trade on momentum, think of a breakout, and, crucially, for getting you out of a losing trade. This is your stop loss.
So this table basically puts it all on one page for you. Look, a buy limit is below the price, a buy stop is above. A sell limit is above the price, a sell stop is below. You might want to grab a screenshot of this. Seriously, it's the perfect cheat sheet to make sure you're placing your orders correctly every single time.
Okay, so how do these all work together? Well, a professional trade isn't just one order. It's a complete plan. Just like investor Marcus Heitkoda recommends, you're combining them. You'll use a stop order for a breakout entry or a limit order for a pullback entry. Your stop loss, always a stop order. Your take profit, always a limit order. That's the structure. Every trade, no exceptions.
All right, so you've got your order placement down to a science now. Surgical precision. But now we need to talk about maybe the most critical piece of the puzzle, the part that really separates the winners from the losers. And that is how much to trade, your position size. This is where so many new traders get completely wiped out.
See, in the world of futures, contracts basically come in 2 flavors: minis and micros. Minis, those are the standard high-risk, high-reward contracts. They're powerful. But for a new prop firm trader, micros are your best friend. They're the absolute key to survival, to building consistency, and to finding long-term success. Trust me on this.
And here's why. In one simple number, as Trader It's Johnny explains, a micro contract is exactly 1/10 the size of a mini. That's not just a small tweak, that is a complete game changer. It gives you an incredible level of precision and control over your risk.
Let's just look at the raw numbers, because this is where it really hits home. If you trade one standard NQ mini contract, you are risking $20 for every single point the market moves.
20 bucks. A few bad ticks and your drawdown can just evaporate. But with the MNQ Micro, it's only $2 a point. See the difference? This lets you fine-tune your risk down to the dollar, perfectly matching your plan.
So the big question is, how do we pull all this together? The order types, the contract sizes. How does it become a repeatable, disciplined plan? Well, this right here, this is the blueprint. This is the exact process you're going to follow for every single trade. No winging it, no deviation.
And it's a super simple 4-step process. Step 1, you decide on your maximum dollar risk before you do anything else. Maybe it's $100. Step 2, you find your stop loss on the chart based on your strategy. Let's say it's 5 points away. Step 3, you pick your tool, the micro contract. MNQ is $2 a point. And step 4, you do the math. Your $100 risk divided by your stop value, which is 5 points, times $2, tells you exactly how many contracts to trade. In this case, 10. See? Zero guesswork.
You know, I absolutely love this analogy. Think about it like you're driving a race car. Your profitable strategy? That's your high-powered engine. It's got all the horsepower. But mastering these mechanics, well, the order types are your gears, and the contract size is your gas pedal. You have to know how to use them together to actually get to the finish line without crashing and burning.
So what are the big takeaways here? It's really simple, but so powerful. Number 1, protect your drawdown. Obsess over it. It's your real capital. Number 2, use micro contracts. They give you surgical control over your risk. And number 3, always, and I mean always, have your stop loss and your take profit figured out before you ever enter a trade. Have a complete plan before you click a single button.
And that really brings us to the final and honestly the most important question of all. Look, the tools are simple, the math is easy, but the one thing that separates funded traders from everyone else is consistency. It's discipline. So you have the tools, you have the blueprint. The only question left is, do you have the discipline to execute it on every single trade?